Welcome, welcome everybody to the first episode of the Money Jam podcast. Let's go. Let's go. How's everybody doing? I hope everybody's doing great. How you doing? Welcome to my co-host, Etiel Ojeda, my man,
Thank you.
my
Thank you,
sidekick,
everybody.
my right
Everybody
hand.
that's watching right now. Thanks, Brandon, for the super intro. I want to thank everybody that's watching right now. You guys make me get out of bed, stop watching Yellowstone to bring you some info and bring you what's going on. And well, I'm not going to spoil it. What we're going to talk about today. So,
Yes,
Brandon,
sir.
what do you have for us today? Tell us. Tell us.
Well,
I'm
you know, we
excited.
we gotta go with the usual market update. Let everybody know what's been going on the markets. And then we're going to be talking today about trading versus investing. So you, as an individual, could either decide or find out which type of investor you're going to be, or if you're going to end up being a trader, depending on your risk tolerance and just lifestyle in general. Uh, Before going into the market update, though, I want to give a big thanks to our community, to our followers. I published a little video on TikTok and on Instagram, just covering the basics. If you want to get started on investing, where to start, whether you're a beginner, intermediate, or experienced. And we got great feedback. You know, got a couple views on Instagram, like 400 views, almost 500. On TikTok, we got like 1,200 views. So
Yeah.
let's go. Let's go. Um, that's great. So we're gonna keep on going with that. We're gonna keep that momentum. We're gonna keep providing you guys that straightforward content so you can enjoy it and maybe learn something. Anyways, for what you came here today, the podcast. Let's start off with the
All
market
righty.
update. What's been going on this week? We had major retailers report
Ooh.
earnings. We had Walmart, we had Target, and besides that, we had some areas of the market that kind of fell a little bit. Plus, we had some areas of the market that actually went up, including those retail companies. And we from retail, we have Home Depot, we have Walmart, we have Target, companies that have seen a rise in demand given the fact that we're finally able to go out of the house comfortably, and more people have the liberty and the commodity of going shopping instead of going shopping online. So I just want to start off by saying that, for example, Target is now increasing its outlook, even though the the
Target.
Q3 earnings, even though the Q3 earnings report were a little bit low. Um, Electric vehicle makers are growing, given the fact that there's growing demand. Um,
Mm-hmm. Mm-hmm.
we have Visa. I don't know if you saw, but Visa, the stock slipped after Amazon said that it's going to stop accepting Visa in the UK. But
Oh. Oh. I was
big,
like, wow. I took
big,
that.
big asterisk there in the UK, given the
Oh
fact
my
that
lord.
Visa fees in the UK apparently are high. So obviously,
Wow.
Amazon being one, if not the biggest retailer right now in the world, uh, saying that it's not going to accept Visa in the UK, well, it's kind of a hit for Visa, right? However,
Wow.
uh, yeah. However, we
Their
have
credit
some,
card. My
yeah, the
bad. I
credit
think
card
their credit
company.
card. Yeah.
So,
It's based with Visa. So
mhm,
that's a hit. That's a
yeah.
hit.
So besides that, the reason why retailers are growing is because of inflation fears too, right? Obviously,
Mm.
as a consumer, inflation affects us. However,
Mm-hmm.
as let's say as a producer, as a seller, as a company, inflation benefits the company given the fact that those products are going to be more expensive
Oh
and
yeah.
they maybe could increase their margins in that area as well. Besides that, on the more political side, which kind of affects our our market behavior, I don't know if you saw Grandpa Biden. Uh,
That's
uh,
your grandpa. That is
is
your grandpa. Don't no grandpa.
is
That
picking
is your grandpa.
who's gonna be the lead of the OCC, which is basically one one of the top bank regulators, right? And it's apparently gonna be controversial. It says here, given the fact that Joe Biden's pick to be one of the most nation top banks regulators is expected to face a tough round of questioning Thursday morning from senators concerned by her research that explores fundamental changes into the financial industry. So, uh, lawmakers are all but certain to grill Omarova over unconventional ideas she's advocated, including magnifying the power of the Federal Reserve to include consumer banking and sweeping checks to the power of the likes of JP Morgan and Wells Fargo.
Wow.
So, Joe Biden picked this lady. Uh, of course, tomorrow is going to be the questioning to see if this actually goes through. But this is going to bring somewhat of a stir to the market, given the fact that obviously what's going on with the OCC will affect how banks and other financial institutions have to go over their protocols and their processes because the OCC is one of the main regulators that oversees all of these institutions' processes.
Yeah, yeah.
So this is going
Before
to
you
be a
keep
good
on
one.
going, thank you, Biden. I'm paying $4 for gas right now. Thank you, Biden. Okay, thank you.
You can proceed, man. You can
Oh,
proceed.
wow. Yeah, thanks to that as well.
Go ahead,
But
man.
this is gonna cause a bit of a stir in the market, given the fact that this might affect interest rates and
Oh
all the
yeah.
gist. So those are the main topics for today. Besides that, the S&P 500 was kind of mixed. You got tech stocks that are
Mm-hmm.
up. Some of the tech stocks are down. Chip stocks are kind of down as well. Financials are kind of down given the fact of the OCC.
Mm-hmm.
And then you got Tesla was up. You got Amazon was a bit up, and the retailers you got TA Max that was up, and all that stuff. So that's it for the market update for today. And let's begin with the main topic: investing versus trading,
Hmm.
trading versus investing. One of the biggest questions you must ask and answer yourself when you're starting your journey into the markets. Why? Because choosing one of these areas or how you're going to navigate yourself in between them will greatly help you in your journey through these markets. I want to start off by asking you, what do you think about investing? What do you think about trading? And how do you divide yourself in between these two?
Well, to put it into perspective, we have to see why do you want to invest and why do you want to trade? Are you looking for the long term or the short term? This short term, it can be maybe you want to make income. You don't have a job. You want to make a little bit of income, which you can also do that with investing. But what are you looking for in the market? Now, there's opportunity in both of them. We see that, let's start with investing. If you want to invest, you're looking to make at least, a profit based on the percentage of return of the S&P 500. You want to do that or more? You want to do less. Now, in trading, for me, I don't know about you. When people say, "Oh, I beat the market trading," how do you know? Like you've used contracts, you've used things that are not normal within investing. You don't hold the stocks. You're just going for money. You're not going for percentage. Um, Now, my opinion, if we're well, I mean, I don't want to spoil this. We haven't even gone through the whole podcast. I'm just gonna say I'm a big trader myself. I'm a big
I guess
trader
we all know
myself.
that. I
I'm
guess.
going. I'm going to leave it right there. I'm going to leave it right there. I'm a big trader myself, but
I
you can't
guess
go
a
wrong with
lot of
investing.
yeah. I guess a lot of members of our community have kind of figured out themselves that about you. But as you said,
I
you
like
gave
it. I like it.
you gave two important points here: short term and long term. You gotta when you come in the markets. That's why we said you gotta ask and you gotta answer yourself these questions, because when you come in the markets, do you want to be in the game for the long run, or as you
Mm-hmm.
said, you want some side income, or what is it that you're doing here, right?
Mm-hmm.
So let's draw this graph, right? You got trading and you got investing.
Pros and cons.
Yeah. No, let's do the short term for trading and then you got the long term for investing. Why? Because another great point you said, when you're doing investing, your main focus is going to be, you know, that the S&P or just the markets in general will averagely return about 8 to 10% adjusted for inflation,
Yeah,
which what you're going to at least want to do is mimic that. So you want your
at
portfolio
least.
to at least generate 8 to 10%.
Mm-hmm.
If you're somewhat of an active investor where you periodically, meaning maybe each quarter or each month, you go back to your portfolio and you look at how you can redistribute your positions, maybe you can go for something higher than what the market returns, which would mean that you would generate between 10 to maybe 15 to maybe 20% a year, which is
Mm-hmm.
amazing. When you're a trader, another great point you said is you're going actually for the money. And identifying if you beat the market is a little bit different, because if today I make 20%, it doesn't mean that I beat the market. I just had a larger profit than maybe the 2% or the 5% or maybe the 3% that the market went up. But it doesn't mean that I beat it, because I can maybe do 20% today, but tomorrow I had minus 50% and now I'm down 30. So
Yep.
that's why it's different identifying if you beat the market, because what you're going to have to do is go for averages. And when you look back at the end of the year, you're going to say, I averaged a 15% return. And then
Mm-hmm.
you're going to say, the market averaged 10%. So I did beat the market, right? So it's a whole different ballgame there.
Mm-hmm.
So starting off this comparison, you're going to want to think, am I in this for the short term? I'm, and when we mean short term, it doesn't mean you're going to get out of the game mid-month or anything. It just means that your positions are not going to last as long as you would do it when investing, which is long term, right? So that's a very important question you should ask yourself. And as Etienne said,
Yep.
he's a trader. He has his reasons. He's had his experience, and it's been a long time coming to where the point where now
Mm-hmm.
we're seeing the consistency and the discipline necessary to actually be profitable and actually beat the market as a trader,
And
right?
don't get me wrong. Sorry to cut you off, but don't get
No,
me wrong. I do a little bit of investing myself. The thing is, taking, at least for me, every situation is different.
yeah,
We have to consider that you can't do investing on everything, but you can do trading on everything. For investing, I was thinking about this today. For investing, you have to fight that right company, with the right fundamentals, a good standing company. And that is hard to find. Nowadays, that is hard to find. I was so impressed by the PE of Apple, even Lockheed Martin, they have good PEs.
yeah,
But if I'm not mistaken, like a couple months before, their PEs were not the best. You were buying things that were oversold. If you go to Facebook right now, the PE of Facebook is
through the
insane.
roof.
What's that other name? Moderna. Moderna. Moderna's PE was crazy by like, I think it was more than 100. It was something like that, more than 100 something. You know, you have to see where you invest your money. But for trading, you don't care. You're just going in there.
And you're
It's
looking for that
either
opportunity.
you're looking for that opportunity. It's either you buy contracts, which we love. You know, we do a lot of option trading. You go for or either stocks or you go for, swing trades. You know, with the
Yeah.
stocks, there is opportunity everywhere that you go. Now, you also have to see that you need the volume.
Yeah.
You know, if you're doing contracts, if you're doing stocks, if you in the sense of swing trades, you have to see there's volume. So putting that in contrast with, between investing and trading, you have to see where you invest. But to trade, there's always an opportunity. Now that doesn't mean you shouldn't invest, you know. But if you're looking for something, a short-term investment, and not everybody is profitable in trading, but there is
Yeah.
profits.
You
How
gave
long
some
did
good
we
points.
take? How long did we take for, at least for me, it was more than a year and something for me to
Yeah.
be
We
able
we
to
started
understand.
we
Yeah,
actually started trading peak pandemic, right? Right
peak
after
pandemic.
March.
Yeah.
Maybe actually like doing it consistently, whether it was winning or losing, mostly losing. I would
Yeah,
say
yeah,
I would
yeah.
say, ending the year maybe precisely this kind of like this, ending summer,
Hmm.
starting fall. I definitely know January was that horrendous month, but you gave some good
Oh,
points.
January.
You gave some good points where we can touch that in more detail because you really went into the technicals of the stuff, which is important to the trading aspect, right?
Yeah.
Again, this is the stuff that you ask yourself to see what am I actually looking forward to do? Am I looking forward to do more technical analysis, which is what you said? You're looking for volume, you're looking for contracts, you're looking for movement, you're looking for the opportunity today, right? As in investing, when you're investing, you're looking for the fundamentals, right? And you said you can trade everything, which is correct. And technically, if you can trade it, you can invest in it. But I know that the point you meant was when you're looking to invest, you're looking for something that is going to be a good investment, not only in this year, not only in the next year. You're looking for an investment that could be generating a nice return for the next 10, 15, 20 years,
Hmm.
right? So that's why you look at the fundamentals. And
If I'm not
again,
mistaken, I think Warren Buffett defines a um, um, long-term investment. Wow, I think it's 4 years. Please, people, don't kill me in the
yeah,
comments if I'm wrong.
four or
Correct me.
five, 4 or 5 or more years, right?
Yes, yes. We're talking about
So
4 plus or five
yeah,
plus.
exactly. So when you decide whether it's going to be short or long term, those analysis as well are going to the focus is going to shift because even if you're doing short-term trading is actually good in a way to maybe know some of the fundamentals, but it won't actually matter because in the short term, as we've said before, the market will do what it wants to do, and maybe the
Hmm.
fundamentals are saying this is a great company, they should be going up. Maybe
Yeah.
this particular day the stock is going to blow down, right? So you gave another great point there, which was either technical or fundamental analysis. And we're going to touch this in another episode so you can actually understand what goes on in technical analysis and what we focus on there, and then what goes on in fundamental analysis and what we focus on there. Both are great to have in your arsenal, right? Both are great to have in your arsenal. But when you're a long term investor, you're great just by focusing on the fundamentals because when you're thinking long term, The technicals don't actually matter because you're not waiting for the result at the end of day, you're waiting for the result at the end of 5 plus years. Vice versa, when you're doing short term trading and you're focusing on the technicals, it doesn't matter what the fundamentals are because you're focusing what's going to happen today. And if today is going to be a movement, whether it's up or down, you're looking to take advantage of that opportunity, right? So, great points you
Yes.
told there. And you kind of hinted at what I wanted to touch next was when you're trading and when you're investing, you have somewhat different strategies when you're making the decision, right? When
Hmm.
you're trading, you're looking to day trade, you're looking to scalp, you're looking to swing it, right? Whether it's stock, whether it's crypto, whether it's options, which again is some of the stuff that you trade or you're looking to trade because of the movements they have on a daily basis. Again, you're looking for that opportunity, right? So just to quickly go over what these are, scalping, you're looking for a quick in and out trade. That means possibly seconds in a trade, the most some minutes, right?
Hmm.
So that's a scalp, as you say, a scalp, right? Bam. When you're looking to swing a trade, or let's first go for a day trade. As the term says, you're looking for a trade that will at least last this day. They could be a couple of minutes, 15, 30 minutes, or maybe an hour or two or three, whatever your strategy may be for that day. And when you're looking to swing trade, it's still trading. It's kind of like mid-term because it could go on for a week. It can maybe go on for 2 or 3 or maybe a month, right? But you're looking for a good entry point that may last longer than a day or two. That's a swing trade. So I think those are very important topics to discuss. And why the stocks and options crypto is something we'll touch later. Because when we're talking about investing, what are we looking to do there? We're not looking again to do a scalp. We're not looking to do a swing or a day
Hmm.
trade. Because as I said earlier, we're not focused on the technicals for this day. We're focused on the fundamentals, which are kind of like foreshadowing what could be the future of the company in 5 plus years. So, what I consider to be the two main strategies for this is you buy and you hold, right? You buy a stock and you hold it for 5 plus years.
Hmm.
And the second, which is the holy grail of investing, DCA, right? Dollar
I
cost
knew you were gonna
average.
say that. I
Dollar
knew
cost
you were gonna
average.
say that. I
Dollar
knew you were gonna say that.
cost.
Actually, fun fact, people, the person who taught me how to dollar cost average was Brandon. I never, ever heard in my life about dollar cost averaging. But that's the thing, you have to learn that.
Yeah.
You know,
So
for investing and trading, you have to learn that.
yeah. So the thing with dollar cost averaging is you're looking to, right? Let's just put a situation here so people could better understand it. You have $1,000, right? If the market is saying, the market has been going up for the last month, right? And you have the $1,000 today to invest. Of course, the best moment to invest is now, right? Let's just start off there. But let's put the situation. You invest those thousand that grand today, and maybe tomorrow the market drops to 5%. So that means that on those $1,000 you have, you're already down 50, right? If you dollar cost average, instead of putting that day the $1,000, what you would have done was put 250, $250. And when you do that, you put 250, which is in this case 25% of that principal. And if the market drops 5%, right, then you're just looking that you lost what, like $1.50 for for your 250 that you put today. But that's better now because if the market dropped that 5%, now you put the other 250. And now you have 500
Mhm.
with a lower average cost basis, which
You
this
keep
is,
on gradually putting that
yeah,
money in. Yes, yes.
exactly. So besides gradually putting that money in, if what's generally happening in this situation is that the market is dipping and it dipped today, right? I put 250 here, but it dipped a bit. I put 250 there. This averages the cost of my investment down. So in general, yeah, I spent 500, but what I got with the 500 is equivalent to what I would have gotten with 550 because I
Hmm.
bought at a lower price. And if I wait and then it goes down a bit more and I bought 250 more, now I got more with that 250. So that average keeps
Hmm.
going down. And when that average is low and then the market goes back up, there is when you see what's called um, uh, delayed gratification, which means
Delayed
is,
gratification. Wow.
yeah. So what that means is, all right, I'm buying and it keeps going down, and maybe this is stressing me out. But now that the market is back on track, now is where I see. I would have seen maybe if I put the $1,000, I would have seen just $50 in profit. But now that I averaged down and the market went back up, my investment went up instead of 5% because of my average, it went up 10, 15%. And that's why I believe dollar cost averaging is the holy grail of investing because this way you're basically adding to that beating the market theory, right? When somebody else just got 5%, you actually got twice or maybe three times as more just because you delayed what you invested and you did it periodically. And now when it goes back up, it just bounces in general. So I think those are two main points. And I'm just going to give you a little bit of time so you could talk about how either a, a good story or a good experience, either scalp, swing, or day trading, or
Why do you have to put me through this, man? What
I
do you?
mean, it's so people could understand what your thought process is when you log into your computer and you're looking for that opportunity and why you make that decision.
Oh man. Well, I don't know if you remember. Well, we used to trade with a good friend of mine from OBR Investments or Investing, I believe is the name. So I started trading with him during the pandemic. Um, at the moment, things that I oh man, I wish I knew the things I know now. Before, just so you know, those things didn't happen. So
Yeah.
I was telling this story to a friend of mine. We started investing. We started doing our thing. January came. We were up to the neck with contracts. No stop losses. So you know what happened, people. Obliterated. Obliterated my portfolio. So now that we come, we're mature in the market. Things that, you know, time in the market beats time in the market
Yeah.
shows us. Now that we have time, now we go into trades, Brandon. And well, thanks to our friend Sam also. Shout
Yeah.
out to our friend Sam.
Shout out to Sam.
Um, we go into the markets now. I used to go super early in the morning, people, like at 5 in the morning. I used to go in there and be like, oh my God, like what's up for today? And I'm doing like all this shit and nothing's happening. Cause at the end of the day, you know, I was just catching a momentum. We were catching trades during the pandemic and everything was rising. So what were we gonna catch? Everything was gonna be profits. There was no fundamentals. Now we go into a trade, and now that we're mature in the market, we don't wake up at 5 in the morning. We actually wake up at like I wake up at 7 because we do other work, but still,
Yeah.
we wake up the
But
minute I
we
open my
focus
computer.
on the market later. We know that the market opens at
Yeah,
9:30. We would maybe start looking 8:39
I
ish.
think I started looking at 8:30 because yeah, I
Yeah.
have meetings at 8:30. I start looking at 8:30, so that anxiety is off my mind. No emotions. We can say there's no emotions, but no emotions
It's
in the
complicated.
morning. Yeah, it's complicated. But another thing is, I never used to look at volume. Why people, there's a lot of things that we don't know, like, things about physics and things about myself of how I trade. We're never going to know how we do it. But I honestly, I didn't know why I didn't look at volume. Volume is key, and that's something you taught me, Brandon. Trading with volume, learning how to look at volume. Um, those are two keys, super fundamental
Yeah.
in the market. Another thing is, I won't spoil it here, but the things we use. I think the instruments we use, they're super helpful on trading.
And
Now
then
going
again,
back, I kind of went away, my bad, of a successful trade. Today I did a successful trade. I know you were not in it, but I did a super successful trade. Um, and
son
it
of a
was because of
bitch.
that.
Son
Yeah.
of-
We're not gonna give the background story to the
No,
people
no, no,
because
no.
it's kind of sad.
Tell us the success.
Oh
Tell us
my
about the
god.
success.
Okay, so we went into the trade today. I was looking at Apple. We used something called the TTM squeeze. I was not gonna spoil it, but we're gonna spoil it. Um, I thought I saw a reversal, but it was the opposite reversal. So as soon as I saw the volume, and as
A
soon as I
reversal
saw,
inception.
yeah, I told Brandon in the morning. I was like, reversal inception. I told Brandon in the morning, hey Brandon, I'm going for a put today in Apple. If anybody was watching the market today, Apple went to like 154. And we were gonna catch it at 150. I was like, Brandon, I think we should go for a put. And Brandon was quiet, he didn't say anything because he was like, oh, I think we should do a call, blah blah blah. At the end of the
At the end of
day,
the
we
day,
went.
let's say you got the call, you went with the call.
And
Let's
Brandon
see
stayed in the
how
put.
much how was that profit, right? As you can see, guys, the thought process here is you get up, you see how the market is looking just before the open, right? Because as at the other said, we used to do this since 5 a.m., right? Pre-market starts at 4. We used to go really try hard, start looking at stuff at 5. But looking at doing all that, it's unnecessary given the fact that again, when you're day trading and stuff, at the end of the day, it might open totally opposite, right? So
Mm-hmm. Mm-hmm.
keep in mind the main points that Etiel is saying here is we wake up early. Now we're doing it 30, maybe an hour before the open. Kind of like see how stuff is behaving. Already at 8:30 a.m., you got people that are already waking up. You got people that are already trading stocks, which are tradable at pre-market hours. So you kind of like get a peek at what the market is trying to do.
Yeah. I mean,
Uh,
if you're in Cali,
it's gonna be very
yeah,
early, of course.
don't wake up at 8 in the morning,
Yeah,
man.
yeah,
It's
you
already
can say,
open. You're already
yeah,
past due. We're at Easter time, okay? We're in
yeah.
the Eastern
So
time.
what he's saying is we now take a little bit more time into just letting the market talk to us instead of us trying to
Mm-hmm.
figure out what's going to happen, right? So very key pointer for those looking to for those who are already thinking maybe I'm a trader, keep that in mind. Let the market talk to you instead of you trying to figure out what the market is going to do. Because you may, as we've said before, and as we've experienced before, you may have all the confirmations right now that it can and it might and it could do this. It could go up because of this, because this is telling me this, because this is telling me this, and because this is telling me this. But when the market opens, or maybe the market is already open, and you're kind of like seeing patterns and you're seeing everything, and you're like, this is what's going to happen now. It could just go haywire,
It can fall
right?
through.
There,
It won't
it
fall through.
could
Yeah.
there, a little, and this we've talked about this before. This fundamentally doesn't matter, but again, on the technical side, and going to the point that the market does what it wants to, just a little headline could appear. Apple did this. The CEO did that. The government doesn't want iPhones anymore. Whatever it could be, poof, your trade goes to the
We
ground.
experienced that yesterday, Brandon, when we were trading Apple. You remember that? Today
Yeah,
was for me, it was a successful trade. I don't know. Yesterday, it was awful. I don't know what happened with awful. It fell through. Um, honestly, we don't know because
but but it was
we,
that. It was that. We started off good. The trade
yeah,
started off good. And the reason why we stuck to the trade was all these indicators are pointing us to the right way.
yeah, yeah.
And all of a sudden, just poof, something happens and it just goes sideways.
It
So
goes sideways. Yeah,
today was a successful trade. And the thought process, again, just to summarize it here, is you get up early, you get a peek of what's going on, but you step back and try and understand what the market is telling you. Don't figure out what he's gonna do next. Figure out what
hmm,
he's telling you now and use that in your trading decisions.
yeah.
So that's for trading. For investing, right? For the long term. Let me do my story now.
Oh.
A successful story. Um,
Oh my god.
uh, let's do it, right? So let's say let's give the most recent, and it might not be in stocks. It is going to be a crypto thing. Bitcoin, right? When Bitcoin reaches previous all-time high at 64, it started dropping, right? And initially, for our community members, what I explicitly told them, what I like to do is I don't buy every single time. I like to buy when I see that the price has dropped between 3% and 5%. When we're talking about a $50,000 asset, a 3% drop is about a $1,500. 5% drop is about a 250 or $2,500 drop, right? So when we're talking about these things, that's I like to put money there because even if it drops a bit more, I already know that if it pumps back up, I got in a better position than just buying the top. So after Bitcoin reaching its last all-time high, so it dipped that 3-5%. I bought again. It dipped another 5%. So from its high, it's already down 10%. So I bought again, and it kept dipping, right? So obviously, here's where we talk about delayed gratification. You get that sense of why the fuck am I buying this when it keeps on dipping, right? We already all those who are in the market know the
Hmm,
meme, or know
hmm.
all the memes about when you buy the dip and it keeps dipping, right? But here's when you start looking at the fundamentals of things and try and gray those gray, remove that gray noise and focus on what's actually good in the project or whatever it may be. Because yes, I stopped buying those each 5% drops, but Bitcoin went down to 50K, so I got it there. Bitcoin went down to 45K, so I got it there again. Bitcoin went down to 40K, got it there again. And it stood in 40K for a while, but what happened next? We got another big drop. Boom, back to 30K.
Oh,
And
I
it
remember
even went
that.
down. and it even went down to 28,000. I have a
I
freaking
remember that.
screenshot of when I bought at 29,000. And what's going on here, right? You have people that in this same period, that means that from the 64,000 high we had, we were down between 50 and 60%. We're talking about portfolios that if they had $100,000, we're already at $50,000. It's a big drop. It's hard on any individual's stomach. That's a fact. But when you have that conviction and you know that this is a periodical, it's a cycle, and you keep by that decision, that's where delayed gratification comes in. Why? We're talking about from 29,000 back to where we are today. That now we're down from the 68,000 that it was
Oh
recently.
yeah.
But still, from where we are today, we're talking over 100% increase, right? From 30,000 to 60,000, that's 100% increase.
Yeah.
So I'm up from those dips that I bought, right? From the 29,000 that I bought, I'm up 100%. But from the 30,000 that I bought, I'm maybe 90% up. From when I bought at 35, I'm maybe 80% up. That's where you get that delayed gratification. Because if I would have waited, sure I might have put all this money close to that 30,000, but timing, as you said, time in the market is way better than timing the market, because timing the market, it's the same probability as getting struck by lightning. You might get
It
struck
doesn't.
by a
It
lightning.
doesn't work for investing. It doesn't work for
Getting
investing.
struck by lightning might happen first before you time the market correctly, and you time the bottom and you time the top. Period. So
Yeah.
now that we're up here, I didn't have to keep investing all the way up. I could have. I just preferred to wait because I already
Yeah.
invested when it was going down. So that's when you get that delayed gratification.
Mm-hmm.
So
Mm-hmm.
back to the thought process, short term, what you did today, you saw the technical side of things. You focused on indicators, you focused on what the market was telling you today. With my story, I focused on the fundamentals. There was a lot of what's called FUD, which is fear, uncertainty, and doubt in the market at that time. There was a lot of news about China banning Bitcoin,
Yes.
about UK banning Binance, which is an exchange, etc. And that freaks people out. But when you actually research into these things, you find out that since its creation, Bitcoin was banned in China. They just keep telling you that over and over again and make it a headline. And when you look at the Binance thing in the
Mm-hmm.
UK, it's more of a bank aspect. It's not because of the exchange. So what you do is, well, this is not our fault. This is because of the UK. And then when you look at the fundamentals of Bitcoin, it doesn't matter if China mining is over now. All you got to know is that now Texas is the number one hotspot for Bitcoin mining, and it's in the US,
Wow.
and
I
it's
didn't
in
know
our
that.
area, and it's in our area.
Wow.
So when you have all those facts on your side, you can let the headline say whatever they want to say. You already know what's actually going on. So you stick by that conviction,
Mm-hmm.
and now you get delayed gratification. So there's two perspectives here.
Nice.
You let the market talk to you for when you want to day trade, and then you let the fundamentals tell you what the reality is of what's going on when you're investing. So you got those two other things, right? And the last pointer I want to talk about here between investing and trading is, and we kind of already said it, is
Yeah.
where are we looking to do these things? And for trading, I basically put stocks, options, and crypto, because for now I believe these are the things that have the most volatility necessary or price
Mm-hmm.
movement for you to make those plays. Whether you won or you lost, it was your decision, but the movement was there for the opportunity to be taken advantage of, right? And you could trade commodities, you could trade bonds or whatever it is,
Man,
but
gold, futures,
exactly, it's
everything,
futures. You got everything. We trade
everything,
oil. You could
everything.
trade oil, but I focus on these three things because I like stocks. Obviously, I like options. Options, if done correctly, the
Mm.
leverage is incredible. And obviously, crypto is incredibly volatile, especially in these times. So again, you have that leverage as well. Now, for investing, my pointers here are: you got stocks, obviously. If you want that exponential growth, you got stocks, individual stock picking.
Yeah.
You got funds. Obviously, there's a lot of institutions that provide funds with different interest rates, with different yields, etc. And one of the good things about investing, you could trade these as well. But then again, what what's good of holding this on the long term is what goes on with them is ETFs. Pretty sure you already know what's
Oh,
going with that.
ETFs. Yeah. Yeah.
And lastly, what you actually take advantage of when you're investing and the compounding of everything is dividends, dividends,
Oh,
dividends,
dividends.
dividends,
We
dividends.
love them. I was already laughing because I knew you were gonna say
You know,
that.
dividends, right? Talk, tell these people about your side chick, Bank of America, and
Oh,
how, and
oh,
how,
I'm
and
flattered,
how,
man.
and right, and how companies like these, actually provide another type of perspective to investors.
Bank of America, they never missed the dividend. Again, don't roast me in the comments if they did.
Boom, roasted.
But I'm sure they never did. Um, the beauty of this, you're holding a stock, and they're paying you to hold that stock.
Yeah.
Who showed me about this was a good friend of mine, Martel. Um, I hope we can bring him to the show so he knows so much about Bank of America. Expert on it. Still not licensed, so we are not giving financial advice.
Exactly.
But he showed me how to do it. You know, for dividends, we always look for the companies that have never missed a payment, a good percentage.
A yield, yeah.
Yeah, I'll say more than 2% for me, more
Yeah.
than 2%.
2% is good. 2% is good.
2% is amazing.
Between 1.5% and 3%, which is a
And
good
and
historical average, you're good with that. You have companies that
and
have a
you're
higher
always,
yield, but
yeah,
they don't
and
necessarily pay it.
for investing you, it's either you try to get the average of the market or you try to get more. And the percentage of dividends that the at least if I'm not mistaken, I think it's the S&P 500. It gives you 2% more. Um,
Yeah.
we always try to go for 2%, and of course, we always try to go for a good good price stock.
Yeah.
Something that its PE is not bad. You're gonna get your good dividends and your good growth stock. Like it's gonna grow. Your value stock is gonna grow within that stock. Um, yeah, I think those are three good pointers, man. Because
No, yeah, of
honestly,
course. Because again, you and um this isn't on purpose, right? We're gonna touch a lot of these topics in more detail as we
Mhm.
go on with the series. But a lot of these technicals and fundamentals like PE ratios help a lot when you're trying to invest, because it helps you determine, is this overvalued? Is this undervalued? Is this height?
Yeah,
Am I investing in something that's not generating enough? Well, those stuff we're going to touch in more detail, but yeah, the pointers you're saying helps us because, as I said, you have stocks that have a higher dividend yield. They maybe pay 10% as a dividend, which means if you have
yeah,
$1,000, that's $100 in dividends. However, maybe they don't have a good payout ratio, which means that, of course, they have a 10% dividend, but they pay it 25% of the time, you know? So
yeah, yeah. Of course.
when you measure all that out, that's why when you focus on let's put blue chips or actually just good value companies that have a historical dividend. They those type of companies have between a 1% and a 3% dividend yield.
Mm-hmm.
So when you look into these things, and here's the great part of it, they pay you that and you have the ability to reinvest it, which means I have that stock of Bank of America
Yes.
that pays me, let's say, $2 for that stock. I think it's a little bit less, but let's just put $2. So for each stock that I have, those are $2 that I'm getting paid each 3 months. That if I had it set up, I could reinvest it back into Bank of
I
America.
mean, why
Free
do you
money,
think?
free money.
Why do you think Warren Buffett loves it?
You
We're
know,
talking about. We're talking
I,
about.
w-
It's
I would say Warren Buffett is the king of dividends, right? You could look it up. We're gonna put it
yes,
here.
yes.
If I can find it, I'll put it here. Warren Buffett makes more on his dividends from Coca-Cola than what the actual CEO of Coca-Cola makes in total compensation, which means in his stock and his
Wow.
salary for each year and his investments. I mean, the guy makes over $500 million in dividends a year because of this guy, because of this company.
Oh.
So imagine that, and then those half a billion being reinvested back, meaning 500 million being bought again in stock. So that means that if this year I had 500 million, next year won't necessarily be 500 million. We're maybe looking at 600 or 700 million, right? So that's the beauty of it. Because besides free money, if you reinvest it, which let's call it what's called DRIP, dividend reinvestment plan. When you do that drip, um, you get that compounded interest basically. Again, stuff we'll talk about in more detail
We're
later.
gonna get roasted in the comments, man.
But
You're gonna see like drip. What is
yeah,
that, bro?
but as you said, those are great pointers, and I think those dividend things are a good thing to leave
Oh
as a
my
hook
god.
for our viewers, because there's a lot of stuff we can talk about dividends. As you said, that good Warren Buffett analogy. I'm gonna look it up so we can put
Who's
it up
not gonna
here as
like
well.
that drip, Brandon? Who's not gonna like that drip?
It's that's the real. When we talk about, oh yeah, this guy has the drip, I actually want to be like, I got the drip because I just got paid like 50 grand in dividends this year. You know, I got the drip. But in the end, what we're
Oh my
saying,
god.
what we want to say is these are attributes that you want to look into when you decide whether you want to be a trader or you want
Or
to be
miss.
an investor. You could actually be both. I'm kind of like both. You know,
Well, I mean,
I
we are kind of
yeah
like
yeah
both.
yeah.
I do trade
I
more. I haven't
exactly.
invested in
Again, it
in
depends.
quite some
It
time.
depends on the
Yeah.
type of person, but I took some time and focused mainly on investing. And now I'm back in the game and I was like, all right, guy, I put some money back in my trading account. Let's get back to trading and let's do this.
Yeah.
Why? Because that's my plan. All right. I want to
Yeah.
have more invested and then all that I invested keep dripping and keep reinvesting that back up and just take advantage of compound interest. And now that I have that cushion, that pillow, where it's all right, if I fall, I'm gonna fall on this nice drippy
Mhm.
cushion. Um, uh,
I can't
I
with you,
can
Brent.
I can trade peacefully, right? It doesn't. Oh, okay, I lost today. I know I'm better off either way because I have
Yeah.
invested.
You can sell the
So
money you trade. You can still
you can put
invest
it
it.
in exactly. So again, you could either decide, all right, I'm gonna be full trader, I'm gonna be a full investor, or I'm gonna be a hybrid. I'm gonna
Mhm.
trade 25% of the money I have available and invest 75% of it, or you can 50-50, whatever you decide, right? This all goes back to our main point, which was you gotta ask yourself, and you got to answer yourself these questions, because that is what's going to provide you clarity. It's what's going to keep you in your plan, right? If you go back in here and you look at this guy and he's like, oh, wow, this guy made $5,000 today and he's trading, it's not necessarily going to happen with you, because when you start trading and
Hmm.
maybe that day you lost $1,000, you're going to be like, all right, this is fake. I'm out. And you can't go like, this guy is investing and he's made $20,000 in dividend this year. You're going to find out that that's because this guy has been investing for the last 5 years and you maybe don't have that patience. So then again, answer yourself these questions, because what you're going to find out is, all right, this guy made 5,000, but it's because he had this and that. So let me start off by doing this. And you start to develop that plan, right? That plan, and you stick by it. And the reason why you're going to stick by it is this plan goes according to what I am, what type of person I am. I'm going to be a
Yeah.
trader. So this is a trading plan. I'm going to be an investor. This is an investing plan. So, closing point, guys, main idea, main topic, main everything. Ask yourself these questions and answer them. And once you have the answer to these questions, then you can start your journey into the markets. I don't have anything else to say. All I could say is, again, thank you guys for the feedback we had on those, on that first video. I will start doing that. I will also like to thank those who watched this first episode for doing so, because this is the first of many. We're gonna do this, and this, I really hope this community grows, because I believe we all will benefit from the knowledge, from the financial literacy, from investing and everything, right? So if you don't have anything else to say, you do? You
No, I
don't? You
just
want to
wanted
say
to
your
say,
goodbyes? Exactly. Do
yeah,
it.
of course. Of course, I want to say
Yeah.
goodbye to my people. Thank you very much, guys, for joining in, watching the video. And please click that like and click that subscribe. That's going to help us out a lot. If
Sure.
you, I don't know if we can do this, but if you guys would like to learn how to trade, how to trade like the big boys, but keeping it simple, we're going to provide a link to our girlfriend and
Yeah.
yeah, Sam. We're going to provide a good link to our friend Sam. He does institutional training. Also, he's been a portfolio manager
Over 2
for
billion.
the over how many
$2 billion in assets.
$2 billion,
Yeah,
over
with a
$2 billion
B.
in
With a
assets
B.
with a B,
Yeah.
with a B. So please go and check out his website, check out his academy, and learn how to be the trader. Thank you guys.
Yeah. Thank
Brandon, take it
you.
from here.
Yeah, thank just that. Thank you guys, and thanks to Etienne for being here, the greatest co-host I could ever ask for. And stay tuned for more episodes like this, where we're gonna go more in depth into these topics, answering questions, answering doubts about certain terms, certain assets, certain stocks, certain cryptos, whatever it may be. Stay tuned for more content. Make sure to follow us on Instagram at the Money Jam Podcast. You could follow us on Twitter at the Money Jam Podcast as well. And just go over all those socials. So thanks again, guys. And remember, keep doing what you do best. And most of all, keep investing. Thanks again. Peace.